Irene Bauer, Chief Investment Officer and Founding Partner for 2020 Investments. Next to her is Shaun, Chief Investment Officer of Nutmeg, and Bryon is also on the panel with us, Managing Director and Head of International ETFs at JP Morgan. Thank you all so much for joining. Really looking forward to the conversation around innovation. And before we kick it off, as I almost forgot it last time, I'm going to do it first now with the poll that we've got. So if you could all get your phones out, and this way we've got time as well for all the voting to come through and we can see how it changes as the conversation evolves. Do you consider artificial intelligence an innovation in investing in ETFs or in the marketing of ETFs? So you've got two options. Get voting on your phones, iPads, whatever. And as the votes come in, looks like we're sort of evenly split. I'm going to put that first question to my panelists. So take it away, Irene. How would you answer this question?
I think I agree. Probably would actually put more on marketing. I think that's really the big area. We've seen Amazon, for example. I mean, it's now becoming a challenger bank offering loans, and I think investment solutions is the next step, and I'm sure they will be very innovative, specifically in the marketing part. So I think we often forget that because we are more in the investment part, but I think marketing is very important.
Shaun?
I find it hard to answer this one, actually. I think from an investing perspective, machine learning is great if you've got a bespoke data set. If you have an advantage with your own data that no one else has, great. But the toolkit is essentially free and available to everyone anyway. So it's all about the value in the data you have rather than the tools you use. So for us as a wealth manager, we see the biggest advantage we have is in having behavioral data around the way customers behave, how they react to market volatility, how they react to blog posts, education about how to deal with this kind of uncomfortable period when you have a big drawdown. So the value is in that data set, not in a toolkit that we can get off the shelf from AWS or someone else. So for me, the value is the data here. If you're a VC investor, you'd definitely say it's all about marketing because everyone's got an AI strategy when they really haven't. It's just a bit of simple regression with some data. But really, I think the innovation in investing is around behavioral data rather than can we drive alpha through having a big data set in our investment process.
Bryon?
Yeah, and I'll pick up where Shaun left off there, right? There's a lot of both going on here. So at JP Morgan, obviously one of the largest banks in the world, we sit on quite a bit of data. And when we harness some of that in the right ways, there's certainly value that can be added for investors and as far as helping deliver better outcomes. At the same time, I think it touches to a slightly different challenge that our industry has, which is we don't often talk in like plain English. And so I think when it comes to like the marketing of these different strategies, you're starting to hear these things, these analogies that are helpful saying, well, this is what Amazon does. Now think about that in your portfolio. And so I think that's why it feels like it's marketing. But really what we're trying to do is come up with non-overly technical terms that allow us to kind of talk to each other in a more efficient way.
Yeah, we'll get more as well into the discussion about artificial intelligence and how that can feed into innovation. But just to sort of get the conversation going as well in terms of the title of our panel is Staying Ahead by Thinking Differently. So we've already established in previous panels that there's a big diversity to the world of ETFs at the moment. So Irene, how would you say if you're investing in ETFs, if you're an ETF provider, if you're in the asset management side of things, how do you stay ahead by thinking differently when it comes to ETFs right now?
I think it's really, well, we have to use data again to get all the different aspects. And one thing we've done at 2020 is we've learned from how we've built our portfolios, and it took us a while, and the tools we built. So we've now also created a fintech company where we are using those tools, and it's just so much faster now to build a portfolio. What took us days is now taking us minutes, and this is something that we then want to distribute to everybody else.
Yeah.
This is one aspect of it.
Sure, and when we've had a conversation before, you made a really great point, Irene, for the basis of conversation. In terms of innovation, you said we can think about it on 3 levels. So you've mentioned the portfolio of ETFs, then within ETFs themselves, and also with distribution. Yeah. So if you could just pick up on that, Shaun, in terms of looking at a portfolio of ETFs themselves, you, of course, at Nutmeg look at both. Where are you seeing opportunities for innovation or innovative ways of investing?
I would say kind of everywhere, really. I
Yeah.
mean, we're going to talk about this a bit later, but I think around socially responsible ESG investing, there is a massive opportunity there to bring this to the masses, where it's only really starting to be an institutional product. And I think ETFs give us that delivery mechanism, also give us that transparency. And on the distribution side, we have huge amounts of data that we expose to our clients. So we give our clients metric around things like their carbon output, which even going back a year ago, I would have thought I wouldn't have conceived that was a great idea or even something I could deliver. But working with customers over the last year, that came up really clearly that customers want to know what's in their portfolio and why is it different to a normal portfolio. So that kind of data set that you have and the ability to deliver it with ETFs is really powering that innovation, but all driven by what customers are telling us.
Mm-hmm. And from your perspective, Bryon, correct me if I've got this wrong, but you explained to me that you're almost like, with your client base, the parts manufacturer building ETFs with them being components of a bigger portfolio. So in that context, how does innovation around those three sort of points, ETFs, portfolios, and distribution, fit into your thinking at the moment?
So I would never correct you because I can't imagine you being wrong, but we do indeed kind of see ourselves as part of the overall value chain, right? Yeah. And when we look at the innovation that's happened across the asset management industry as a whole, there's been a number of shifts that have happened. One of the biggest ones is the user interface of how investors are investing is changing. Shaun's a perfect example of that, right? That wouldn't have existed, 10 years ago, and now here you can download an app and you can get that exposure to it. Along with the shift of how investors have invested, the ETF vehicle has come along, which helps provide the component parts to build better portfolios on behalf of investors, right? And so, Shaun's organization, a number of the organizations represented here, do a fantastic job of identifying what the investment outcome the investors are looking for, identifying what are the different tools that they have to build that outcome for them, and then delivering that. Where we come into the equation is we spend a lot of time thinking about what's the most appropriate tools that we can develop in more precise ways so that investors that pull those tools together can deliver a more precise outcome for the end user. And we see this happen in a number of different ways. The previous panel was good talking about how index development is evolving, and we spend a lot of time thinking about how we can evolve the different exposures that we're providing through an ETF wrapper as well.
Yeah, and what's great about this panel too is we've kind of got two sides of the coin here in terms of, with you, Irene, you're working mainly with financial advisors, wealth managers, portfolios of ETFs, and you've said to me it's important to get the risk level right. And of course, your client base, Shaun, a lot of them, if not all, are retail. So we've got two very different perspectives, which I want to sort of get into a little bit here. First, with you, Irene, when you think about innovation around ETFs for your clients, is there a lot of appetite for more innovation? Do they ask a lot of questions around sort of new or diverse types of ETFs?
We get some questions, and if you think about, so we distribute our model portfolios via the financial advisors, wealth managers, so the demographics is probably quite different, or at least a little bit different to Nutmeg, for example. And so we have ESG portfolios as well. We haven't seen that uptake yet. It is some trusts and so on, but so it's probably not quite at the sharp end. For us, it is more than about how can I better put the portfolios together. And yes, we get then questions from our clients, which are the financial advisors, because they then want to, they have to talk to the end client, and in the end, we build portfolios for the end clients. We shouldn't forget that. Mm-hmm. So it's really kind of, for us, it's the indirect thing. And yes, of course, it's just about markets. So where are we going? Why have we invested in this and not in that? What do we think will happen in the next few months? We have a few geopolitical events and...
Just a few. Yeah.
Exactly. So we always think it's interesting times at the moment. It probably was in the past as well. So it's just about guiding them through that and giving them information of what they can talk to their clients. Then also about the behavioral finance. Well, you shouldn't get out. At some point, we'll get to a trough in the markets and also probably in some portfolios. So you shouldn't just get out at some point. Mm-hmm. You should get through that. And for us, of course, not to even get to that point.
Yeah, look, on informing sort of clients, I have to, hand it to you, Shaun. You've got a great section on your website on Nutmeg explaining ETFs, lots of sort of frequently asked questions that clients can look at. You were talking about behavioral data. How does that inform where you think the next areas of innovation should be within ETFs?
Well, I think we use that data in all parts of the organisation just to get a really good understanding of what customers want and what are their unmet needs, really. And I think often we get very concerned about the ETF ourselves and then the industry, where's it going? But actually, our customers, to a large degree, don't really care. Unfortunately, sorry to everyone here, they care about, are they on track to meet their goals? How much risk are they taking? What's volatility like? How do they get through this investing journey, which can be really difficult? So ETFs are a fantastic vehicle. Generally, our clients like them, but I would say probably half of our investors don't really care at all. As long as they are on track for their goals. They care that it's low cost. They care that they can see the fees in pounds and pence. That's always been really high up on the list of why people like Nutmeg. It's ease of use and transparency over fees, 1 and 2. Investment comes down, unfortunately, about 4 or 5 for me as CIO. But it's about transparency, and ETFs give us that transparency, and that's what we love. Also, the T+2, mutual funds, T+ whatever, I can get my clients' money back to them in 2 days, which is really important when you have an online service and you make it so easy and digital. They think if they click now, they'll get the money in their account in an hour. Difficult to live up to that kind of Amazon experience in financial services. Click to transfer my pension, ring up the next day, where is it? And we know it can take six months sometimes because of all the paperwork going in the background. So you deliver this great UX, you have to meet that need. And ETFs give us that scalability. We're currently running 90,000 portfolios. I couldn't imagine doing that with mutual funds. We have 7 people in investment, 6 people in trading and ops that are running 90,000 portfolios. There's no way I could do that in mutual funds. ETFs give me that scalability.
Yeah, so you've mentioned 3 points there, the cost, the transparency, and the sort of immediacy of being able to actually see your investments, which draws people towards ETFs. But to your point that there might be clients that don't really care if you're investing in ETFs or not, how, Bryon, can innovation help draw more people towards ETFs that might otherwise not be that concerned about them as an investment vehicle?
So I'm trying to compose myself now that I've learned that nobody cares about my ETFs. But
I like them.
Thanks, I appreciate that, Shaun. I think Shaun makes the perfect point, which is nobody does care. What they care about is their personal experience. And I think that something has happened in a number of industries, and I think it's happening to the asset management industry as well, which is we used to say things like buyer beware, because the issuer or the provider had more information, and so we would know things like there's a likelihood this thing might break within 2 or 3 years, and so buyer beware. There's too much information and too much transparency out there now. It's issuer beware. We're on alert, right? The investors have so many opportunities, so many different solutions that we are held to a higher standard to deliver that, because if they don't want our thing, they'll just go to the next thing. So we have to hold ourselves to that standard now of issuer beware, because we will know that investors won't embrace the different strategies that we've had. Now, on the point around innovation, I like to take us back and just do a little bit of history. The S&P index was invented in the 1920s, 1923. It wasn't put into a mutual fund until the 1970s. It wasn't put into an ETF until the 1990s. To think that there won't be innovation over the next 100 years that takes us to a new investment outcome, even though we've seen that innovation over the last 100 years, if you will, I think is crazy, right? I think we will see unbelievable amounts of innovation over the next 100 years, that maybe AI, like the first poll question, will be part that drives that. Certainly consumers and practitioners will say, this tool doesn't quite do what I wanted to do, and they'll hopefully tell folks like us, and we'll say, oh, that's a really interesting observation. We could tweak it like that, and then would it achieve what you're looking for more accurately, yes, we've just had innovation. It might be incremental, or it might be huge leaps forward, but we are firm believers in innovation, and we're going to see significant innovation. I think it'll accelerate over the next 5 to 10 years.
Now, to dovetail that with what you were saying about issuer beware, and also to go back to a point that Shaun Haggerty was making in his introductory speech, when he was talking about innovation, he said, you know, sometimes with innovation, of course, there can be an introduction of risk, and introducing risk can introduce regulation. So my question to you then, Bryon, is how do you innovate while mitigating the risk, or at least communicating it in a way to regulators that it becomes healthy innovation?
I don't think that inherently new means risk. So I think I would challenge the premise slightly. I do think that there's a human reaction of the unknown, and I think that we experience that in Europe on a pretty regular basis when it comes to the ETF industry of, I've never done this, da-da-da-da-da. If you look at the mutual fund industry, it's been around for 50 plus years. And so most of the people that are now practitioners of the mutual fund vehicles, which are perfectly great vehicles as well, never had to learn this new thing. They just knew that from day one, and it was the thing. So now ETFs appear to be the new thing. Are they innovation? Yes. In the same way that people were scared of the radio, scared of TV, scared of the internet, all of these other new innovations, scared of the printing press, scared of the, you get the point, right? Like innovation, people tend to be scared of change. And if you don't embrace that, then you kind of become irrelevant, right? And so I actually would challenge it the other way in saying that, yes, you should do your due diligence. Yes, you need to make sure that you do your research, make sure you understand exactly what you're trying to accomplish within your portfolios as it's applied to ETFs. Do that due diligence. But don't be scared of it just because it's different. That doesn't seem like a great answer.
Sure. I think as well it's in terms of the types of ETFs that might be launched, if there are any that do end up being more risky. I mean, for example, I mentioned this all to you before the panel, SEC Commissioner Hester Pierce, who's been dubbed Crypto Mom and has been in the press quite a lot recently, calling for the SEC to facilitate financial innovation and experimentation for ETFs. And the question that's sort of arisen is, would that lead to reputational damage for the ETF industry? Because the danger is that ETFs get bucketed together, you get one kind of innovation that goes a little bit wrong, and suddenly everybody says, oh, wait, ETFs are too risky. Your thoughts on that, Shaun?
Yeah, I'm quite worried about this. I think if a mutual fund blows up or locks investors in, we don't say the mutual fund structure is wrong. But if we have that in ETF, people say the ETF structure is wrong, and there's something at fault with the ETF structure. So I have a massive problem with trying to experiment and see what breaks and fails. I think ETFs are a great long-term investment vehicle as well as a short-term trading vehicle, but they shouldn't be things to sort of mess about with. It's got a lot of credibility, and that credibility is building, and it's taken a lot of time for a lot of people in this industry here to build up that credibility, particularly in Europe, where there's a lot of resistance to ETFs. So I'd hate to see that kind of hard-won credibility lost because of a few exotic products, particularly these kind of inverse and leverage vehicles.
Irene?
It's always a trade-off between the two. I mean, we already have now a few crypto ETFs here in Europe, and maybe that's a good thing. I think, yes, there is some, I wouldn't say experimentation. Maybe experimentation in ETFs is a bit too strong and negative, and maybe we shouldn't do that because, yes, it could damage it. But maybe it's okay. I don't know. People have very different views about crypto, whether it will take up or not, or maybe we need a new. My opinion is we probably need some more innovation there to actually make it a proper global currency, and it's not quite there yet, and we probably need a new product there, and maybe then an ETF on that would be good.
And is this also, Bryon, about sort of communicating with regulators from the very start and working with them rather than against them?
Yeah, absolutely. I think one thing that often goes missed in the ETF industry is that for the vast majority, at least for us, and 90% of the assets across Europe, they're in the UCITS structure. there's no kind of special regulation that ETFs apply to differently. It sits within the same exact regulatory framework as the rest of the asset management industry across Europe, and the issuers abide by those already existent regulations. And so we think that the regulators, do a really good job of kind of understanding what it is that they're trying to do, protecting investors, providing appropriate guidelines and tracks for the asset management industry to go down. And so a high level of communication and transparency on that level is certainly beneficial. And so, I think they do a fine job. I think that we need to, continue to communicate through that way. I think a couple of regulators put out pieces recently where they did a deep dive on the ETF industry, and the result was roughly, looks fine. Which is great. We kind of welcome that scrutiny because then it does increase the confidence for the investors.
Yeah, and looking at future investors as well, one conversation that I had with one of my previous panelists, actually off the panel, was about the fact that you've got a huge amount of millennials now coming into the investing universe, and they might look at things very differently compared to investors from previous generations. The polling's over. No. On that topic of millennials, I imagine quite a lot of your clients fit into that category, Shaun. And what kind of opportunities does that provide for innovation, having actually a different generation of investor?
I think very, very challenging. So we haven't deliberately targeted millennials. We have quite a few of them. Our average age is 40,
right,
which is probably older than most people would expect. But
yeah, that's not millennial. Okay.
I know it's not, but we have them. Their expectations are very high, very, very high, much higher than other age groups.
Yeah.
And they expect instant delivery. Everything app-based, everything very digital, costs to be virtually zero. They're used to a lot of things being free. Frankly. So they're very demanding, and that helps us with our product development for other segments, because we know lots of the innovations that are targeting millennials will work through the different demographics. But it works across all age grades, really. You can talk about the retired generation using Facebook. You wouldn't have said that 10 years ago, or using kind of video chat and things like this. So I think these things, the innovations you see in a younger demographic, they naturally go to an older demographic over time.
And it presents maybe an opportunity for ESG as well. I think all of you have some comments to make on this. Irene?
Oh yeah, definitely. I think millennial and ESG, it really goes together. But actually, it's not just the millennials. It's now kind of going to all age groups. And I think it's really what Bryon said before. Oh, actually, nobody's really so much. The end investors, they aren't quite interested in all the details of an ETF. It is about stories. It's about making it important to them. I think that's really the important aspect. That could be ESG, that could be the Slim ETF, that can be, I don't know, any of the new thematic ones, but then also from a portfolio perspective, that you need to make it important to them. Goals are another thing. So I think that's how we need to innovate, to really make it, many people just say, sorry, investing is boring. And you can understand that when you're not in the industry.
Shaun?
I think this is massively important, and it's a wonderful growth opportunity for the ETF industry. When Trump got elected, we had lots of our customers saying, can you remove the effect of Trump from my portfolio? And you kind of laugh at that, but you understand where they were coming from. And actually, obviously, I couldn't deliver that. But people want their values reflected in their portfolio. And some people simply won't invest unless your portfolio is on a sustainable basis. So we spent a long time working on this with our customers. They wanted to know their portfolios have real impact, and that's why we brought in data to show them what their carbon output is. What's the share of female directors on their board? And that's on their app. They can see that real time. We work with MSCI to deliver that. I think we're the first wealth manager to do that. That's so important for clients. We've done that for all our portfolios, not just for our socially responsible portfolios. And they really are engaged with what is going on in their portfolio that you wouldn't see with a normal portfolio. So we launched at the end of the last year. We have 6,000 customers with SRI portfolios now, which is quite a big growth for us. And they're so engaged on single issues, and they want to know why is that particular company in the portfolio. And overwhelmingly, people want to move to a lower carbon portfolio, if not a zero carbon portfolio. And that's obviously a challenge to deliver. And I think it's a great opportunity for the ETF industry to deliver great products, not just in equities, but obviously go across the broad asset class spectrum. For example, a high yield ESG ETF would be really exciting. More development in green bonds when there is more supply. I think the ESG industry within ETFs is going to explode.
Bryon?
The ESG question is a great one. 100% on board, think it makes a ton of sense. The thing that I spend a lot of time thinking about is when push comes to shove from performance and ESG, where is this going to break? And I always tell a quick little story about this, right? So I'm having dinner with a friend and he said, oh, my wife wants a Tesla. I said, oh, that's great. Why does your wife want a Tesla? He said, well, because it's battery powered. And I said, that's interesting. Like, let me save you 50,000 pounds, buy a Nissan Leaf. And he said, nah, doesn't want a Nissan Leaf. I said, why not? Tesla's faster, it's cool looking, it's got the big screen on the thing, it does all of these other things. You download your software, right? What you wanted was something that performed amazing and was the coolest gadget and just so happened to be battery powered, right? And that's what I think about a lot within the ETF industry is we need to develop things that are performing that also abide by all of the ESG requirements that are out there, right? I don't want this to be, some of the automakers that got caught with the cheat devices, right? Because they were kind of cheating on the devices. We need to have a credible proposition here that improves the investor outcome through a performance or a risk-adjusted return or whatever their objective is, but also abides by some of the important ESG criteria that are playing into it. And so we spend a lot of time thinking about those trade-offs within the portfolio.
Shaun, you're nodding. I want to move on to AI, but
I think we found this through testing with our customers. They expect a very big performance drag from an ESG portfolio, and when we told them we didn't think it was going to be very much, they're prepared to accept quite a drag for that values-based portfolio. And actually, we think long-term, these portfolios are going to outperform. So it's going to be an interesting dynamic, but customers do come with an expectation that they're prepared to pay a cost for this.
Yeah.
That's great.
Let's go back to the polling question, because we started on artificial intelligence and sort of put investing versus marketing. But I just want to look at the investing side of it. How do you see artificial intelligence actually helping with the investing side of ETFs, whether it's through the ETFs themselves or even in the team that you build in your organizations, Irene?
Well, I think we have to look at Jim Simons there and his Renaissance technology. I mean, you have to think about how could they get 35% year on year in performance after fees. That's incredible. And to him, it was important not to have people from finance there, so it's the diversity. Mm-hmm. But then it's also just having fun at work. You know, there aren't many people that left Renaissance technology. I mean, once you got in, you probably stayed there because it was a very good place to work. You got wealthy anyway, so it was kind of, so emulating part of that, the diversity, not the secrecy that some people have and that hedge funds did have in some places. I think that is a very good step. And then, of course, we need, let's not call it big data, because that is one thing. I think it's just data science in general that we have everywhere, and we just need to utilize more and more of that.
Shaun?
Yeah, so we have 5 data scientists at Nutmeg, and I think they give us most value on customer insights rather than the investment process. We've looked at it from our side, and we just don't have any bespoke data that no one else is going to have. You know, we've done a lot through economic data. I don't think it really yields you much insight that you can have a lot of confidence to allow the kind of machine learning to run your process for you. Some interesting tools around risk, but not really stuff you could let run your investment process yet.
Right?
Yeah, I touched on it earlier as far as where I think innovation comes from and the development of new indexes, the development of kind of different strategies that have the opportunity to deliver more precise outcomes. So we think applying AI to that kind of proposition, there's definitely innovation to be found in that space, and it'll just take time to develop. We're spending a lot of time doing that on both the thematic side, across the portfolio, and a number of different areas.
Yeah, I also want to talk a little bit in terms of sort of, again, it came up in an earlier panel, the active versus passive. So on that sort of front, the SEC agreed in April to the launch of the first non-fully transparent, actively managed ETF, and the innovation had to wait 8 years for approval. So first of all, that's a reasonably long time, which might tell us something about maybe the pace of innovation from here. I mean, just your take on that process and the fact that we've got this non-fully transparent, actively managed ETF. Shaun?
Well, I own ETFs partly because of transparency, so I'm not happy owning an ETF. I don't know what's in it. All the lesson from the financial crisis is we need to know what's in our funds, even if it's a standard corporate bond fund. There's some stuff in there you probably don't want to own when the tide goes out and you're during a financial crisis. I don't want to find that with an ETF. So I always want to know pretty much on a daily basis what I own in my portfolio. It allows me to do a lot of analysis to really understand the risk. So I always want transparency, so I wouldn't buy it.
Mm-hmm. Is that something also non-negotiable for you, Bryon?
No, not necessarily. So we would think about it like this. We would think about passive or index tracking, fully transparent. We also already pretty significantly do active, fully transparent. So it doesn't necessarily have to be non-transparent. We do active, fully transparent. We've got both equity and fixed income capabilities in that category. And then indeed, as you rightly point out, there is now this new capability where you can do active, non-transparent. We think this is an interesting development because there are some strategies where when you provide the full transparency, it can impact the efficacy of that strategy's ability to deliver alpha. So think about a really concentrated portfolio where, maybe, emerging market small cap, where the portfolio manager feels that by having concentrated positions, they can provide significant performance in that space. If we're providing that transparency on a daily basis through a transparent ETF structure, that alpha opportunity may go away because the rest of the market will see that, can capture that opportunity. So there are certain investor outcomes where not providing that transparency on a daily basis, but in line with like what the mutual fund industry does, which is more monthly or quarterly basis, we do think that there are tools that can be developed that can actually help investors build better portfolios. So we're thinking along the three. Index-based, passive, 100%, fine. Active, 100% transparent. You can check it on our website. It's there all day long. Or the non-transparent, or what I would call delayed transparency, if you will, where there's a unique strategy we think can provide significant amount of value to investors and does protect the efficacy of that strategy. We do think that there's opportunity there as well.
Bryon, in terms of innovation, is it a case of where the US leads, the rest of the world will follow?
So I'm an American living in London for 7 years. I'll answer it like this. I think that we've seen the ETF industry in the US develop more rapidly for a couple of reasons. One is the infrastructure was just a little bit cleaner with one settlement body, consolidated tape, and an exchange structure that lent itself well. Obviously, the fragmentation of Europe is well documented, and and I don't need to go into the languages, exchanges, all of that sort of thing. I'm a believer that innovation doesn't necessarily have to happen with just green space. I think constraints can drive innovation as well. So for example, when the flash crash happened in the US, there was a lot of talk in the US. There was no flash crash in Europe because there was a bunch of different exchanges that didn't happen as quickly, and so there was no issue whatsoever. Things like trade platforms, RFQ platforms, haven't developed as nearly to the extent in the US as they have in Europe, and maybe there's some benefit to that. So I don't think I would accept 100% innovation happens, more in the US and less, in Europe. What I would say is that the innovation is going to happen differently because of the constraints in Europe might force innovation in a really good way. I do think you should be able to throw the ball forward in rugby, but that's a completely different topic.
That is a great point, that constraints can sometimes lead to innovation. We're pretty much out of time, but just a final thought from Irene and Shaun on that and the fragmentation in Europe that Bryon's brought about. How might that either constrain or lead to more innovation? Shaun?
Well, I think Europe's more innovative on trading, and we've found so much value in really optimizing the trading. With different counterparties, different time of day, different venues, really have found so much value in that, which I don't think we would have found if we were on the US just giving it to the exchange all the time. So I think different approach, but actually yields some really significant benefits.
Irene?
Yeah, I couldn't agree more. I mean, maybe we don't want everything that's currently hyper in the US to come over here. So in terms of the fragmentation, yes, it's a problem, but hopefully we get the innovation as well, and we've already started on it.